Hi everyone, welcome to YX Insights. This is Yimin. Today we're going to do a market update, first focusing on the picture of liquidity versus risk assets, then moving on to live chart updates for the equity indices, TLT, gold, silver, Bitcoin, Ether, Solana, as well as Mag 7 stocks, and our latest trade setups in energy. So if we start with the Fed liquidity versus SPY, our definition of Fed liquidity consists of the Fed's balance sheet less the Treasury general account, which is the US Treasury bank account with the Fed, less the reverse repo program, which is money markets essentially lending money to the Fed to collect overnight interest rates, plus the bank term funding program, which was set up to rescue the defaulting regional banks last year. But that portion now has come down quite significantly in the past year. So together, this will give us a picture of the overall liquidity in the system, as seen in the red, versus SPY performance. And so our theory is that better liquidity, of course, would help with risk assets rising, and reduce pressure on funding, therefore lower yields, whereas worse liquidity could provide a headwind to equities, and also put an upward pressure on yields. So as we've seen that towards the back end of September, we saw a sharp drop in Fed liquidity, around 400 billion. And that was going into the September month end. But since then, in October and November, we have seen a steady comeback in liquidity levels. And you can see that this sharp rise just pre-election helped fuel the subsequent rise in SPY. However, since the election, so in the past couple of weeks, the overall Fed liquidity has dropped slightly. And that has not really helped equities to further capitalize on the post-election tailwind. And we've seen that SPY has stalled somewhat in the past couple of weeks. And the picture for yields, as we can see that the 10-year has moved significantly since the September FOMC. It's been nearly a 4 percentage point increase from the September low. And you can see that this bottoming yields corresponded with this local top in Fed liquidity. And as the liquidity dropped in September, we've had 10-year yield moving higher. And even though the Fed liquidity overall has bounced back a little bit, it hasn't really helped the yield slow down. And that's more because of the forward inflation expectation for Trump's policy, and investors are worried that the Fed's policy, the cutting cycle, could actually take a pause to accommodate for the high inflation expectation. And just to run the actual numbers here, we've seen in the past 2 weeks, we had a net drop in around $60 billion. And that corresponded with SPY and QQQ both moving lower in mid-November. The indices have recovered somewhat since then, but there hasn't been a huge tailwind from the liquidity side of things so far. This is a rolling 30-day correlation between 10-year bond yield and QQ and SPY. So what we have seen is that actually from the summer onwards into October, that correlation has become more and more positive, from an inverse relationship to actually positively correlated relationship in September and October. And I think that could be explained partially by the carry trades being back after August. You can see that August was actually, the carry trade unwind was actually at the flipping point from the negative correlation to the positive correlation between yields and equities. And the theory is that I think that some of the carry trade players have taken the opportunity of high US yield to put the characters back on. And what that means is that they're borrowing low yielding currencies like yen, the Japanese yen, Chinese yuan, and Swiss franc, and then swapping them into high yielding assets. For example, US Treasuries, some European peripherals, as well as the stock market. And now just looking at the global liquidity versus Bitcoin, which of course seen a massive spike since the election, which seems to be relentless. We've just had this really sharp breakout, and that doesn't look back. But what I've found is that there is about a 10-week lag between Bitcoin price versus the global liquidity. As you can see, the global liquidity is in red. It accounts for for me, I'm using the M2 levels of the US, the UK, China, Japan, and the Eurozone to approximate the global liquidity picture. And you can see that the Bitcoin and the global liquidity chart with the 10-week lag corresponds pretty well over here. So as liquidity rose, 10 weeks later, Bitcoin moved into 70s, and that's when we had the wave 3 high. And then it consolidated for around six months. And then we had the breakout post election into the all-time high. However, the picture from late September, early October, have seen a drop in global liquidity primarily because of a stronger dollar. So what that means is that all else equal, the local currency liquidity provided by, for example, the Eurozone, Bank of Japan, People's Bank of China, as well as the Bank of England, are translating to a lower amount of dollar liquidity. So in terms of dollar value, which is what Bitcoin is quoted against, that liquidity has dropped. So as we're approaching the end of this rise, I think we have about 2 more weeks. I do expect Bitcoin to start retreating, which we've seen actually in gold and silver, which I'm going to talk about right now. So in terms of gold, which I'm using GLD as approximation, the lag is smaller. So, and I think, so from what I've seen, the lag is about 3 weeks instead of 10. And that kind of makes sense because gold is a bigger market, and there are many more institutional buyers and central bank buyers in this market versus something like Bitcoin. So this liquidity picture feeds into gold and silver much more quickly. And you can see that, so with a 3-week lag, as the global liquidity rose from end of last year, GLD rose 3 weeks later and started climbing, and it actually topped as the global liquidity topped in late September, early October. And what we're seeing here is a retrace first, and this bounce does correspond to this leveling of global liquidity here. And actually, I do think gold has further to retrace. We can see gold matching this liquidity drop in the coming weeks. Now coming to silver, I think the low in silver, the local low in silver versus the local top we've seen here corresponds quite well with the global liquidity picture as well, with a 3-week lag. And we have also seen a slight bounce this week in SLV. And I think that will be a short-lived bounce. And with gold as well, we're going to see a further corrective move down. So I do think the global liquidity has explained a lot of the moves in non-income yielding assets like gold, silver, and Bitcoin. And I think this chart will help us guide through the cycle generally. And here is a familiar chart of the 10-year bond yield versus the spot 5-year inflation versus the 5-year inflation expectation versus the oil prices. And what we have seen is that the bond yield corresponds pretty well with the spot inflation expectation because of the expectation about Trump's tariff policies. And of course, he's running a 4-year term. So the forward 5-year inflation expectation actually hasn't moved that much. And it's more driven by oil. What we have seen, and I think we need to be a bit cautious, is that oil has recently toned up. We have a trade on for US oil, and actually I've picked a couple of energy stocks that have potential trade setups as well to hedge us against potential further spike in yields driven by the oil prices. But overall, I think I'll just be mindful of the impact of oil on the forward inflation expectation too, which could further feed into the 10-year bond yield. So at the moment, the FOMC picture is rather simple, actually. The market expecting a cut in December mainly, but possibly skipping December into January, but one cut between 1 to 2 meetings. And then we'll have a pause, and we'll have another cut in the summer, and another pause, and another cut in the fall. So overall, we're just expecting 75 basis point cuts from here now, which is actually incredibly shallow compared to what we had priced in before the FOMC or back in August when the non-farm payroll data were pretty bad. So I think the key data point now is the next month non-farm payroll, because we just had a pretty bad set of non-farm payroll, but that could be explained by the port strikes as well as the hurricane. But and that could be explained away as a one-off situation. But if we don't bounce back in terms of non-farm jobs added in December for the November data, we could see yields coming down substantially because people would expect recessionary odds to rise and the Fed having to cut more. And here is a yield curve for the US Treasury yield. So there's a spot to 1 year, spot to 2 year, etc., out to 30 year, versus the forwards yields. To be honest, both charts look very similar now because the yield curve is pretty flat. So we're not pricing in that much of a drop in yields. And essentially, all parts of the curve is now above 4%. To me, what the market is signaling is that we are having elevated inflation for longer, and we're not thinking about recession anytime soon. So the market is pricing away the chance of a recession and pricing in further inflation. But that pendulum could actually shift pretty quickly when we have bad non-farm payrolls data. So, so here on the balance, I think excluding the oil picture we just mentioned, on the balance, I think the risk is on yields coming down and therefore bond prices rising. But if that didn't happen, and because oil prices are driving further inflation expectations, therefore higher yields, we're hedged with our US oil pick as well as our stock picking energies. So I think that is a sweet spot to be in. So SPY, my primary expectation is we should still hit this 620, but possibly not before this month end, likely into Christmas instead. And it's because this we've had a wave 1 and 2 here. If we are completing here, it's very, very shallow for wave 3. And I think we'll have to think about if this is a 3-wave up, what maybe the market is turning more bearish. I don't have that view just yet, but I'm very aware of the potential of the liquidity headwinds we discussed earlier. And I'm happy to relook at this chart if the technicals fail to line up towards further upside. So my primary expectation is still further bullish, and I haven't really changed those counts since I put them on last. And it's been pretty much within our expectation. But if we're getting more clues from the price reaction and also the liquidity charts, that maybe there is further downside than upside, I'm happy to change my mind as well and relook at our thesis. Similarly, QQQ, I do expect us to at least reach 520, 524 again, and ultimately 550 at some point, possibly maybe by the year end or beginning of next year, maybe in January. And this is a resistance. I think the technicals, even as we had this mini job, don't quite paint a bearish picture just yet. And to me, all of this looks like fairly healthy corrections. TLT is taking quite a lot of time trying to consolidate in this bottom zone. And I do think we've put in a low here, but technically speaking, we haven't seen enough evidence to suggest that we are going to bounce. I do think we're putting a low here because of how tight the market is already pricing for the Fed's subsequent decisions, only 75 basis points priced in. And if it's being driven by oil, if higher yields are being driven by resurging oil, we have trades in USO, as well as the latest trade set up in Diamondback Energy to hedge that risk. Apple, I actually think we are poised to break out again soon. Just looking at the overall technicals, this is the VWAP from August low when we had the crash. It's tested its VWAP a couple of times. It always stopped in this around the same red line here, climb out again, and it's trying to move past this volume profile here. And all of this suggests a consolidation zone where people are more or less accumulating rather than trying to sell. And as the market is still in profit, there's actually not as much pressure to sell when it starts to take off. And I think in the near term, we could see 260 being reached soon. And Apple has just rolled out its Apple Intelligence in English-speaking countries. So some of the catalysts could come from positive feedback from there and positive iPhone sales. I was in Tokyo this month, and when I walked into the big Apple stores in Tokyo, central Tokyo, they said its iPhone 16 Pros are all sold out. I have to order online. And of course, that's a very anecdotal piece of evidence. But to me, I don't think there's that much headwinds for Apple going higher. Plus, they have a stock repurchase program that essentially has helped the market. Tesla. So we had a drop towards 307. Theoretically, this could have been wave 4 could have been completed, but because this wave 1 and 2 is quite steep, so wave 3 and 4, so the wave 4 correction can be shallow, so it can stop here. But the subsequent bounce has not really taken out this post-election high. So this may well be a B wave, and if we get down here, a C wave down to 280, mid 280s, or even low 290s, I think is a pretty good re-entry opportunity. I still think Tesla will get to 400 in the medium term, so that would be a pretty nice re-entry for trade setup. Microsoft, so the Mac 7s generally have faced a lot of pressure in the past week in terms of price action. Microsoft, to be honest, has held pretty well as Amazon's, Meta, Google, and even NVDA retreated. However, it's just a little bit sloppy as well in terms of the upside move. We haven't really had a decisive move yet, having consolidated for almost 10 months. So I think a lot of trade volume has been built around this price, 410 to 420 area. It should serve as a springboard when we start moving, and I still think the near-term target should be 850-ish. I'm just going to put out the red alternative here, the bearish alternative, which is why we have a trade stop loss. And the bearish alternative would say this is wave B, very similar to Google, which will come up in a second. So this is a wave B, and we have a wave C lower before we can attempt higher. So if that is the case, we're being protected by stop at 385. But to me, I think just looking at overall market technicals in SPY and QQQ, it's hard for me to imagine a world where SPY and QQQ are moving up and Microsoft is moving down significantly. But having said that, Microsoft only rose by 20% versus 30 plus percentage points in the indices in the past 1 year. Next up, Amazon. I think we are seeing a wave 4 correction here, which is still above the wave 1 I've marked earlier. And I think the next move up should be a move higher to 230. And I think the way to think about Amazon is that it's basically two businesses. One is retailing, selling products online and in physical stores. And the other business is essentially AWS, which has a different multiple, valuation multiple to the e-commerce side. And together, my fair value for Amazon is about 230 in stock price. And I think that lines up quite well technically with this wave 1 high. So I do think we should, we've had a retrace wave 4 and the next up is wave 5. If I'm wrong and if I were to enter trade here, I would put a stop at this wave 2 low. So I'm actually right now considering opening up a trade idea on Amazon. Google in the near term looks a little bit like Microsoft in the sense that we had 3 waves up, but not quite enough to take out the previous high to essentially confirm that we're in an uptrend. And technically speaking, 3 waves up is not sufficient for the motive wave, and usually it's a counter wave move. So we still have this red alternative of breaking a new low in wave C. And I have hesitated on putting a trade idea because of it. However, also like Microsoft, we've accumulated heavy volume around the current price point, and we do have a wave 3 target at 270. So if we do enter today, for example, I think the risk reward is probably quite good if you have a stop at this wave 2 low. The risk with Google is that essentially the DOJ wants Google to sell its Chrome business, and I think it can get quite messy. Search is about 50% of Google's revenue. So I just think the whole thing can be quite messy, and it's a bit messier than Microsoft, even though the valuation is more attractive. Meta, it does feel like that wave 4 has not quite finished, as we essentially yesterday we broke a new low. What we do normally expect is a wave C being equal length or just slightly higher than wave A. So 1.236 extension of wave A from the top of wave B. So we could technically say it's completed or near completion, but I think the price action just doesn't give us a lot of confidence right now. It could travel down to 540 potentially, which actually isn't a bad entry point to target this wave 5. So I'm just going to watch the price action develop a bit more to decide whether we should put on a trade or not at this moment. So my conclusion is that the medium-term trend is still up. I still can see the stock going past 700 at some point. Just the very short term, we're still seeing a lot of corrective action in the price. NVIDIA, actually pretty good set of results, but now the pretty good set of results for NVIDIA is always been expected. So the bar has become really high, and investors just didn't feel that excited by the results as they used to. NVIDIA has heavily influenced SPY. So if you run NVIDIA and SPY side by side, you can see they basically move in tandem. So I think a lot of the stagnation indices has also been held back by NVIDIA as well. So to me, I'm still, like for SPY and QQ, I still see near-term upside, even though this is a resistance zone and then we can turn wave 4 from there. But overall, I still see a higher, and I think we're still in wave 3, the heart of wave 3 of 3, which is the strongest, which typically is the strongest wave. And we've actually just broke this all-time high that was back in July. So I don't have a lot of reasons to be bearish on NVIDIA. I think we just need to be a little bit patient for the price to play out. CRM, a very bullish chart, but I think is running into near-term resistance here at the 1.76 extension of wave 1. And typically you will see the stock retrace to somewhere around around here to 307 level. And I think if we get that retrace, it could be a nice entry point to play the final wave, wave 5. Or even if you're even more patient, we can wait for this entire wave 1 to complete to play the wave 2. ADBE, it does feel like this November low was the bottom. We had a sharp drop last week, but it stabilized quite a bit. I just want the near-term price action to give me a bit more confidence in the overall trend reversal. And if we do enter a trade here at 510, I'll target the 710 level or 700 plus level and put a very tight stop around below this wave C or even below this VWAP at 670. So that's how I think about it. So Netflix, extremely bullish chart at the moment, even after the incredible fight between Paul and Tyson last week, which of course everyone complained as being incredibly boring with loads of buffering. Netflix doesn't seem to be stoppable in its price movements, and that's because it's in wave 3 of 3 of 3, which is the strongest wave, part of the uptrend. So for me, I would really want to see the price action complete wave 3, just shy of 1,000. We get a pullback to 850-ish level, and before considering entering for the final wave 5. So it's quite difficult to chase given how fast and steep this rise is. Unfortunately, we missed the boat. We just have to wait and pick our spot better. Shopify, I put out a piece recently on Shopify. Really love the fundamentals. Essentially, it has 2 businesses. One is in subscription, which has annual recurring revenue with high gross margins, and the other one being more transaction-based in terms of, for example, Shopify Pay and other volume, gross merchandise volume-related fees. After the earnings, we had a big pop, 20%. I think that's reached the wave 3 of 3, and we've just had a wave 4 correction. So in the near term, I actually do think it can go back up, turn back up and get to 125, 26 level to complete this wave 5 of circle 3. And then we can have a slightly bigger correction in wave 4 before finally targeting wave 5, which is anywhere between 140 and 160. So I think a very bullish chart, and it's a really good business. I'm just waiting for the right spot for a trade setup, and I'll have a think about that over the weekend and possibly put out a very short-term trade for this wave 3 completion, or we can wait for this wave 3 and 4 to finish and have a slightly bigger trade, bigger reward for this wave 5. City moving pretty nicely against our trade entry. I think it had been a little bit sluggish since the election pop, but I do think the next wave, the overall trend is well maintained. It just moved past this wave A high after election. So we should be well on our way to wave C. The wave C is typically 5 waves. So we just need a bit more price action to give us a better clue on how this wave C could manifest. SLB, I like the business a lot. It's technology for energy sector. And they're doing pretty well in terms of growth, as well as profit margins, I would say. As we're seeing here, we had a wave 1 and 2 just after COVID. And I think we've completed wave 3 here. And we're actually now in the wave 4 correction. This wave 4 correction has taken a long time. It's been nearly 2 years. But I do think there's one more leg higher for wave 5. And we could reach as high as the mid-70s to mid-80s to finish off this cycle. In the near term, I do think we haven't quite finished this wave C. I see 1, 2, 3, 4. And we're just waiting for this 5th leg to complete before we set up a trade to aim for the wave 5 high. Next up, FANG, down and back energy. It's a very similar chart to SLB, but I would say even more bullish because I think it's already having wave 5 underway. So we had wave 1, 2 in post-COVID, and wave 3 finished in 2022, just before the bear market. And I think now we are entering the wave 5 or 5. And I actually have a trade set up to enter at roughly today's price 184 and to target the wave C of wave 5, which is 250 level. And I think a tight stop around 160.67 is pretty good. This risk reward is about 3-to-1 risk reward for this trade. And overall, it does, again, I think it corresponds to energy moving up as well in terms of our USO chart. One thing I would caution is that because it correlates with the price movements of USO. So if I had a USO trade on, I would actually think about the position sizing as a whole for the energy basket for SLB and FANG with the USO, because even though they're 3 separate names, they correspond to very similar market risks. Gold, GLD. Around this, so last week we actually flagged that GLD could have bottomed and could be bouncing soon, and they actually did. This is a wave B bounce. I think wave B bounce typically, if it's a flat, typically it would be 70 to 90% of the wave A. So I've marked here as the near-term target for 253. So we're pretty close here. And wave B is notoriously difficult to play because it's so variable in terms of where it. So if I did play this bounce, which I personally didn't, I would now start thinking about maybe taking some profit as we approach this 253 level. I do think we still have a wave C to go. And just to looking at the liquidity charts we had earlier, I think the overall drop in liquidity should lead gold lower in the coming weeks. SLV, similar to gold, I do expect a corrective bounce here and then a drop lower to complete wave C of 4. And after wave 4 for both gold and silver, I do think there's a final leg where potentially there's more inflow in the North American and European ETFs and more retail chasing it. Bitcoin, of course, surprised to the upside, even though I was very bullish already before the election. I kind of expected a bigger pullback in wave B, which had been the case for previous moves. But it seems that we just have a very shallow retrace here, and we are heading towards 120 in a much more direct fashion. I think 100K is a big psychological hurdle. So there is every chance that we stall below 100K for a little bit before breaking higher. Also, there is alternative chance that we do have wave A topping here, just around 100K, and then a much bigger pullback and a sharp rise into wave C. And that would be an excellent re-entry if you already took profit. Ether. So I think we had a very strong breakout post-election in Ether, even though it did lag behind meme coins and Solana. However, I think what we have previously, I thought it would be taking shape in the diagonal structure with ABC, etc. But actually, looking at this impulsive move up, I do think we're moving 5 waves here into 1, 2, 3, 4, and 5, and we're part of the wave 3. We've completed wave 3 and 4 of wave 3. So I think we should see the next leg higher, breaking about 4,000. And then we can get a retrace afterwards. And then ultimately, my target for this cycle is 5,000 above. Solana did better than Ether in this cycle so far. It moved towards this, it completed 5 waves in a much more direct fashion and moving towards this wave 1 high. And I do think we are reaching the resistance level now here, and we are pretty much at my target price for wave 1 high. I actually marked this before the move happened. If we get something like a normal pullback in wave 2, we could target 600 plus for wave 3. But the caveat is that for me, Solana is a much more centralized cryptocurrency than either Bitcoin and Ether. And I think it does depend on the network activity as well versus the Ether. So they are in direct competition with each other. Ripple, well done to the Ripple holders. He actually did a pretty incredible comeback, going from essentially 40 cents now to $1.44. And that has cleared my previous bearish path. And I think we're now moving in an impulsive manner. And I think with 3 targets around 2, and we get wave 4 pullback, and we can finish wave 5 around 420. However, I will just caution that by no means this is a reliable timeline on how quickly, how slowly it could happen. We had, between the end of wave 4 to this wave 2 low, we essentially had 2 years consolidating in this area. And it can be a very painful 2 years with your capital locked up. Coinbase, I think Coinbase is actually retracing now for the wave B. Even as Bitcoin moves higher and Ether moves higher, Coinbase hasn't really been able to break above this previous high here. So that suggests there's a lot of near-term resistance to the upside, and the easier path could be just making a corrective move down here. And I think 220 to 240 is an excellent re-entry point. And ultimately, my target is around 600 for wave C of 5. And I think that 600 level would essentially complete all of wave 5, which actually brings us higher than the IPO price. I just want to touch on BILI as we have a trade set up with it. We have a stop loss at 18, and we're pretty much there. And I think because we've dropped below this wave A low, those wave C has much lower to go. So I'm actually happy to stop out already and then just wait for the dust to clear. And very similar to KWEB, I think because we've reached this wave A low, I think the wave C could be lower before we get higher in the medium term. So I think, in the news flow, it would manifest something as the liquidity support from the government is not enough, etc. It takes more time to get the stimulus right. And then we get the pessimism to settle in again before we move higher to clear above this previous high. So that's it. Thank you for tuning in today. If got any questions, please just ping me on chat, and more than happy to answer. Happy Friday, and see you next week.